dear students, today in this video, in this lecture, we are going to discuss the expenditures. Now, the first thing you need to understand in this lecture is the difference between the expenses and the expenditure. Now, there is a clear difference between the expenses or the expense and the expenditure. Like you have studied electricity expense, you have studied rent expense, you have heard regarding the interest expense, you have heard regarding the stationery expense, insurance expense. Now these are the expenses you have already heard of. Expenses, electricity expense, rent expense. Remember when we talk about the expenses, which are the utilities, which are the interest expenses, stationery expenses, insurance expenses, they will always be recorded as an expense in the statement of profit or loss. That means they will always be recorded as an expense in the income statement. But when you talk about the expenditure, there are actually two types of expenditure which we are going to study. The first one is known as the capital expenditure, and the other one is known as the revenue expenditure. Now, whenever you talk about the expenses, there is no argument that these expenses should be recorded in the statement of profit or loss as an expense. But when you talk about the expenditure, there are actually two categories: capital expenditure and revenue expenditure. The capital expenditure in general is recorded as an asset in the statement of financial position. So we do not record this thing as an expense, rather than we capitalize it as an asset. And similarly, the revenue expenditures will be expensed out in the statement of profit or loss. Now, what is the difference? If you say expenditure, then you have to go into further detail whether it is the capital expenditure or the revenue expenditure. The capital expenditure will be recorded as an asset in the statement of financial position, and the revenue expenditure will be expensed out in the statement of profit or loss. But there's no point of going into detail when you heard about the expenses. If it is electricity expense, rent expense, interest expense, that is going to be recorded directly as an expense in the statement of profit or loss. But still there is a difference. When you talk about the utilities, this is going to be the expense, and simply that will go to the statement of profit or loss. But what if you are buying the goods, buying the stock? Now when we are doing the accounting equation, we actually discuss one thing, that the goods we are purchasing should be recorded as an expenditure. Now that is known as the revenue expenditure. Similarly, if you have an asset and you are doing the repairs or maintenance, that is known as the expenditure rather than expense. Although the treatment is same, expenses are recorded in the statement of profit or loss. Revenue expenditures are also recorded in the statement of profit or loss. Although the treatment is same, but there is a difference between the expense and the expenditure. Because in the expenditure, there are two types: capital expenditure and the revenue expenditure. Now, there's no need to be worried about if you are still confused regarding this thing, because we are going to discuss this concept in quite detail in the next few slides. But for right now, remember that when you heard about the expenses such as utilities, stationery expense, insurance expense, rent expense, that will be recorded directly as an expense in the statement of profit or loss. But when you hear regarding the expenditure, you have to go in further detail whether it is capital expenditure or the revenue expenditure. The capital expenditure is recorded as an asset in the statement of financial position, while revenue expenditure is expensed out. So in terms of treatment, expenses and the revenue expenditures are same. So we can say that in terms of treatment, in the statement of financial position, only capital expenditure will be capitalized. And if you talk about the statement of profit or loss, expenses is also recorded, and revenue expenditure is also recorded in the statement of profit or loss. So in terms of treatment, expenses and revenue expenditure are the same, but the capital expenditure is different. That is why we say there's a difference between the expenses and the expenditure. Now, first of all, we will be talking about the capital expenditure. Now, the general thing you should remember that if you are doing any expenditure on the non-current asset, which is related to the acquisition, like for example, if you're buying any non-current asset, such as computers, laptops for business use, or a building. So any expenditure on the non-current asset, which is either related to the acquisition or extension, like for example, you have a building, you are making one more floor of it, so this is extension. Similarly, expansion, such as you have a warehouse, now you are extending it, you are expanding it. Or improvement, for example, you have a machinery which is currently producing 1000 units in a day, and you are doing expenditure on it which will improve its efficiency and will take it to the 1500. Or upgradation, for example, you have machinery which is currently 1000 cc and then it will become 2000 cc's, for example. All these expenditures are known as capital expenditure. So if there is any expenditure on a non-current asset which is related to acquisition, extension, expansion, enhancements, improvements, upgradations, that is going to be recorded as a capital expenditure. And by capital expenditure we mean that these should be capitalized. Capitalized means that these are recorded as an asset itself or part of an asset. So this is the thing you should remember regarding the capital expenditure. So either it will be recorded as an asset itself or as part of an asset. Now, an expenditure is a capital expenditure if the benefit of the expenditure extends to several trading years. Now, this is the definition of the non-current asset, if you remember, that the benefit is more than 1 year. Benefit or life is more than 1 year. Now, this is the basic concept you studied earlier when you were dealing with the non-current asset and the current asset. Now, the non-current assets are the assets which are for business use, and their benefit or the life is going to be for more than 1 year. That means for several trading years, such as 5 years, 7 years. Capital expenditure may include the following expenditures, although I have discussed this thing with you, but now we'll be studying expenditure incurred on the acquisition of fixed asset. Fixed asset means the non-current asset, which is the other name of the non-current asset. Either you are talking about the tangible or intangibles. The cost of fixed asset would include all expenditures necessary up to the time the asset is ready for use. Now, this is an important thing to understand. Say, for example, you have purchased a non-current asset. So, one component may be the purchase price. The other component may be the installation cost, like you are spending something to install that asset. And to install that asset, maybe you are paying the professional fee to someone to install that asset. Maybe before putting that asset into production, you are making it test by someone, so there is a testing fee. And you have to pay some legal fees to acquire that asset. Now remember, not only the purchase price, but all of these expenditures which are necessary to bring the asset in the working condition will be part of the asset cost. Let's take a simple example. What if someone asks you to sell this non-current asset? Are you going to sell this simply on the purchase price? No. You will be saying that, look, I have paid the professional fee, I have paid the legal fees, I have paid the installation cost, so you have to pay me this thing as well. So all of the expenditure which you have incurred to bring the asset in the working condition is going to be part of the asset as well. Money spent on improvement of existing assets, so as it increase their life or reduce the cost of production, for example, conversion of hand-driven machine to a power-driven machine. Like there was a machine which was used manually. Now you have done the expenditure so that it can be used automatically. So it became automatic. Previously it was manual. Now that means there is an improvement in the existing asset. So this expenditure should be capitalized. This should be part of an asset cost. Similarly, expenditure on the extension and addition of existing fixed asset, for instance, cost of making addition into the building, furniture, machinery, like you have extended your warehouse, you have built more floors into your building. So all of these are going to be the capital expenditure. So this is something very important to understand, because you have studied the non-current asset, but at that time you just talk about the building, you just talk about the furniture, but you didn't talk that what type of expenses, what type of expenditures, what type of components when we talk about should be capitalized. So capital expenditure. Now I have already given you a summary of this. Capital expenditure is when a business spends money either to buy a fixed asset, that means acquiring the fixed asset, purchasing the fixed asset, non-current asset, to add value to the existing fixed asset. Included in such amount should be spending on acquiring fixed asset, bringing them into the business, legal cost, carriage inwards, that means the transportation cost, any other cost needed to get fixed asset ready for use, such as testing, etc. So all of these are the capital expenditures, and you will be recording this thing as an asset itself or part of an asset. So this is something you need to remember. Now we'll be moving towards the revenue expenditure, and again this is something very important to understand. The first basic thing is that these are the expenditures. These are the expenditures which are other than capital expenditure. These are the expenditure which are other than the capital expenditure. Now say for example, I told you that if you are doing an expenditure which adds the value to your existing fixed asset, for example, you are upgrading your asset. Now what if the efficiency of your asset was deteriorated and now you are doing expenditure just to maintain it? Let's take an example. For example, there was an asset, machinery. When you bought this asset, it used to make 1000 units a day. Now after you used it for 1 year, now it is making 800 units a day, because the efficiency has deteriorated, efficiency has fallen, efficiency has reduced. Now you spent $200 on it. You spent $200 on maintenance. so that it starts 1000 units again. So $200 is being spent to bring the asset again into the same condition. So after this $200, again the machinery is making 1000 units a day. So how this $200 should be recorded? Whether this is a capital expenditure or a revenue expenditure. Remember, this is a revenue expenditure because you have spent this thing for maintenance. There is no upgradation, because upgradation means this is something which takes it to more than 1000 units. But this is not the case. The efficiency was deteriorated and now it is making 1000 units. So this $200 was spent for maintenance rather than improvement or upgradation. So this is a revenue expenditure. Similarly, all day-to-day expenditures related to trading activities of a particular accounting period. For example, purchase of goods or stock. This is actually a revenue expenditure. And how we record it, we have studied this thing in the accounting version. This is cost of sales, or also known as cost of goods sold. So in the statement of profit or loss, we record this thing in the cost of sales or the cost of goods sold. Similarly, maintenance of existing earning capacity of non-current asset. This was the existing capacity. So we just spent $200 to maintain it, to bring it back. They do not add value to the non-current assets. They are of regular nature. Now, for example, regular nature is like you are changing the plugs, you're changing the oil, etc. Even the petrol. Their benefit is short term, recorded as an expense in the statement of profit and loss. So the main difference between the capital expenditure is the capital expenditures are capitalized in the statement of financial position. They are recorded as an asset. But revenue expenditures are recorded as an expense in the statement of profit or loss. So this is the basic differentiation you need to learn. Now, revenue expenditure, which is not spent on increasing the value of the fixed asset, and it does not add value to the non-current asset, but on running the business on a day-to-day basis, these are the known as revenue expenditure, such as purchase of inventory, such as repairs, maintenance. The difference between revenue expenditure and capital expenditure can be seen clearly with the total cost of using a van for a business. Buying a van is a capital expenditure. The van is used for several years, is therefore a fixed asset. So you are spending on a fixed asset and this is for the acquisition. So this is the capital expenditure. Paying for petrol to use the van, which is a daily expense, is a revenue expenditure. So this is something you need to remember. Now, we have a very good example right in front of you, which will make you confident regarding the revenue and capital expenditures. So differences between capital and revenue expenditure. Expenditure, for example, buying a van. Now this is related to the acquisition. So this is a capital expenditure. Petrol cost for van, daily use, daily expense, it's a revenue expenditure. Repairs to van, now repair and maintenance, revenue expenditure. Putting extra headlights, so this is an addition to the value of the asset, capital expenditure. Buying machinery, again you are acquiring something, acquisition, capital expenditure. Electricity cost, so these are day-to-day things, daily expense, revenue expenditure. We spend 1500 on machinery, 1000 for an item which is related to improvement added to machine, 500 was for repairs. So 1000 is capital expenditure because it was for improvement and addition. The rest was for repairs, so this is revenue expenditure. Painting outside a new building. Painting outside a new building. So this is the first time expenditure. First time expenditure. You are making a building and first time you are painting it. This is a capital expenditure. 3 years later, you are repainting the building. Now you are maintaining it. Maintenance. This is a revenue expenditure. So I hope with these examples, you are quite clear regarding the concept of revenue and capital expenditure. Now the last thing we need to discuss in this video is incorrect treatment of expenditure. Now obviously you have so many things, sometimes people get confused and they record revenue expenditure as capital expenditure or capital expenditure as revenue expenditure. So it is possible that the capital expenditure is incorrectly treated as revenue expenditure or revenue expenditure is incorrectly treated as capital expenditure. What is going to be the effect? Effect on accounting equation. This is the thing you need to understand. Effect on the accounting equation. Look, capital expenditure is recorded as an asset. Revenue expenditure is recorded as an expense. This is recorded in the statement of financial position. This is recorded in the statement of profit or loss. Now the first case. This is the first case. Capital expenditure is incorrectly treated as revenue expenditure. So what you have done, when you have treated capital expenditure as a revenue expenditure, you have understated your assets because you have recorded that thing as an expense rather than asset. And similarly, you have overstated your expenses. And similarly, by overstating your expenses, you have understated the profits. Capital expenditure should be recorded as an asset. What if you treat that thing as an expense? So you have understated the asset, overstated the expenses, and understated the profits. Now the second case. What if you have recorded revenue expenditure as a capital expenditure? The first impact would be on asset. You have overstated the asset because it should be recorded as an expense rather than asset. Expenses are understated because it would have been recorded as an expense, and profits are overstated by not recorded the expense. So this is something important for the objective test question. You need to know what is the impact on the accounting equation when you have recorded the capital expenditure as revenue expenditure or revenue expenditure as capital expenditure. So hopefully you have understood the concept. Make sure you go through this example and see whether you are able to understand through this example. Read these slides, which will make a clear difference between the capital and the revenue expenditure.